Perfect. Thanks very much, everybody. Lovely to see so many people here, and welcome to the UK's COP29 pavilion. Just to make sure that we're all in the right room, this is an event on blended finance to support sustainable agriculture. I'm very excited to be here because this is my second day in my job as the new UK Special Representative for Nature, and actually my first sort of public event in this space. And I really particularly wanted to do this because I, like many other people, and most of you will understand that action for nature and action for sustainable agriculture are not really separate agendas. They're fundamentally part of the same story. And the reason that they're part of the same story is because if we want to support people who are protecting nature and natural systems on the ground, it's clear that we need to ensure that there are sustainable livelihoods available for those people. And also, we know that if we want to maintain resilient, sustainable agricultural systems, we need natural systems to be able to support that, whether it's through things like the role of forests in generating rainfall and supporting shade, or through things like healthy and sustainable soils. Ultimately, nature supports agriculture, agriculture supports nature. So for me, it's very important to be here. But at the same time, we know that there is a huge funding gap out there to support the transition to genuinely sustainable agriculture that provides food security, supports people's livelihoods, estimated at about 350 billion a year. And we also know that as it stands at the moment, only 5% of the total amount of climate finance flowing is flowing into agricultural systems, which I think for many of us, when we look around and speak to colleagues who are here at COP and thinking about what climate change means for them, is an extraordinary state of affairs, given that billions of people around the world are directly dependent on agriculture for their livelihoods, and that agriculture is being impacted by climate. We really need agriculture to be a bigger part of the story on climate and a bigger bit of the finance pie. So this conversation today is about how we therefore use a combination of public and private finance to unlock a much bigger part of the pie, and to ensure that the kind of finance that we're going to hear about today that is flowing towards sustainable agriculture and livelihoods becomes not the exception but the norm. And we've got some amazing panelists who are going to tell you a little bit about what that's like. They're going to offer you examples of the way in which they're working in their various different roles and funds to be able to get this money flowing. And I'm very glad that my new role enables me to say that we as the UK government are significant investors, I think to the tune of $50 million into these sorts of activities. But what we're also hoping to hear from our panelists and from you is a real challenge about how we overcome the barriers to scaling up, so that we are not in a situation where we're constantly looking to find ways to leverage more finance into the system. But what we're seeing around us is essentially the dam breaking and most of the finance that flows into agriculture, if not all of it, flowing into sustainable systems. This, I understand it from my colleagues, is part of a dialogue that we're going to be continuing during the course of the year. And it's really important to say that some of that dialogue must, in fact, lots of it must involve our partner governments in different countries where investments are happening. It must involve farmers. It must involve those people who are actually the recipients and also the actors and the bringers of solutions. So that will be going on during the year, but I'm going to now start to hand over to my excellent panelists with a little bit of background information on each of them. And the setup is going to be that they're all going to give a little bit of an introductory speech, but we do want to get on as quickly as we can to then having some interventions from you guys and having a bit of a dialogue. So I'm going to introduce all three of the panelists and then pass over to the first one, if that's okay. So we have with us Lachlan Cameron, who's joined us from Finance in Motion. Is a leading impact asset manager with many years of specialist experience in investing in projects that contribute to sustainable development goals. We're also going to hear from Jason Spenceley from the Global Environment Facility. You'll all know the GEF, a multilateral environment fund that provides grants and blended finance for projects related to biodiversity, climate change and other environmental issues. And then we've also got with us Christy Graham from the Australian Sustainable Finance Institute, Institute, who has been explaining to me the role that her institute plays in working very closely with the Australian government and with the private sector to support them in the kind of decision-making that will unlock the sorts of investments that we're talking about. So, if okay, with no further ado, I'm going to pass over to Lachlan to introduce us with his first comment. Thanks.
Thanks, Ruth. And does everybody hear me? Okay. Yeah. Super. So thanks for the brief introduction. And yes, we're an impact asset manager based out of Germany, though we have 15 regional offices across the world where we're investing. What we are doing as a fund manager is that we design, we structure, we fundraise for, and we invest different impact funds, including blended finance funds. And what we mean by that when we say impact investing is that every single investment that we make has to do good and contribute to a positive outcome for people or planet. But it also means, particularly in our case, that we're exclusively investing in emerging markets. And so our track record to date over the last 15 years means that we've invested in more than 40 different countries across the global south. In terms of size, just to give a sense, we currently manage around 4 billion euros of assets. And more than half of that is focused on climate action. And the majority of that is blended finance. And so we feel that we have some views to add today that should hopefully be useful. Just to extend the sort of introduction and context about why we are such believers in the power of blended finance and why we think that it needs to grow substantially. So about 2 or 3% of ODA at the moment goes towards blending, even under a really broad definition of what blended finance can mean. And yet we know just how powerful it is at mobilizing private capital, at driving additional capital into emerging markets. And so we have this huge challenge that was hinted at. We need to, the latest CPI numbers suggest that in the agricultural food system space, we need to grow that by 35 times. Actually, while we are really proud that we've doubled climate finance in the last 4 years, that hasn't been the level of growth we've seen in agricultural systems. That's really lagged. And it's left us with this enormous gap. So we have these tools of blended finance. We've been deploying them for a long time now. And we have this challenge of how we can grow them, and it needs really focus and political will and make sure we really commit to these things. So I'd like to give you a quick case study of one of the funds where the British government is invested and that we advise. So this is a fund called the Eco Business Fund. It's focused really on agriculture, sustainable agriculture, sustainable forestry, sustainable agriculture, aquaculture, and agribusiness. In Latin America and Sub-Saharan Africa. And so the size of that fund today is about $850 million US. It's in 16 countries, and it's partnered with more than 50 different financial institutions, and I'll come back to that later. And so to give a little bit of a sense, that sounds really sort of very abstract or very high level, that we have this large fund. We have one story from the ground. So there's tens of thousands of such stories in the fund already. And we have just one, I think, video that hopefully will play where we can tell just one story from the ground of what the fund is doing.
This province of Los Rios, where CocaCola has its operations. There, they buy cocoa from small producers. CocaCola has a Rainforest Alliance certification and plays an important role in the value chain by encouraging sustainable practices for small-scale cocoa producers. The company helps recover degraded areas, promotes management and conservation of water sources, and works to prevent soil erosion. It also promotes good post-harvest practices in all aspects of grain fermentation and drying. This reduces waste and final product loss, increasing the producer's income and achieving good quality.
Okay, so blended finance. It sounds like, I think, often like a complex or intimidating topic, and how do you do it and what is it? And so I'd like to try and demystify that just a little bit. And so I think you can think of blended finance in really two big hard sides of a coin, so to say, right? One side is where do you get the money from and how do you mix it together, if I put it very simply. And the other side is what do you do with the money and how do you do something useful with it. And in a kind of financial setting, you might call that what's the sort of liability side of a finance fund and what's the asset side. And so I'll just try to give a few things that we think are important in the agricultural space on both sides of this coin. So if we start sort of really on where do you raise from, how do you raise funding, how do you structure that, how do you mix it? And so the first point I'd like to make is you have to build something that will scale. Yeah, it's great to solve specific problems, but if you really want to sort of magnify agricultural finance that we see to the level that we need, you have to build things that will scale over time. It has to be replicable. It has to attract additional capital. It has to be willing to grow. And so that's, to take this example of the Eco Business Fund, it's $850 million today, but when it started, it was far, far smaller, a tenth of that. And that track record and that ability to go into new markets, that ability to have an offering that is valuable to investors, but also to investees, has proven it, and then also allowed it to grow. And that's what I think we need on the first case. The second thing I would say is really create products that resonate with private investors. There's so much talk about what private investors want or mobilizing private capital. And actually that's relatively simple. If you sit with private investors, they will tell you really clearly what they want. They'll have certain requirements around the type of product. Is it a fixed return product? Is it an equity product? They'll tell you if it should be rated. They'll tell you how liquid it should be. They'll tell you what kind of tenors and terms. They'll tell you if they want it to be listed. You know what people want to invest in. Yeah? We have to offer them things that meet their needs. And the other big thing that they'll tell you is they'll tell you about what size of investment they're willing to make. And so you need to be able to create things at size so that private investors can come in and see the sorts of, they would say, a ticket, right? Like what's the minimum investment they'll consider? What would make them be interested in this niche, new, different product, and that they'll do due diligence on it and maybe invest. So that brings me to another point, which is I really think, and this is maybe more to the overall climate finance community, I think we really need to be conscious about making sure we keep a focus on established, successful models. And what I mean here is that there is an opportunity that we talk a lot about, inventing new things and innovating, and this is needed in many parts of the agricultural space, but there are also really well-established, successful models out there that we should commit to and grow. So the private sector, when they look at something and it's big and it's been working a long time, they would say, well, that's successful, we like that. And it also needs the public sector to look at those big, long-term things and say, yes, we like these and we want to continue to support them. So that's the last thing I would say on this liability side. And then on the asset side of a fund, right? So what are you going to do with the funding that you've got in order to be impactful in the agricultural space? The first thing I'd say is you make sure you build around multiple objectives. So Ruth hinted at this, that nature and climate are just so deeply intertwined. And so you will often be achieving multiple objectives. But if you really build for this from day one, it gives you, I think, a better set of arguments. Firstly, it resonates more with the investors. But secondly, it also resonates more with the investees that you want to reach. Climate mitigation might not resonate for a primary producer in Colombia, but the topic of resilience really does. Yeah, and the ability of sort of like guaranteeing cash flows from year to year to year, and resonates with their own experiences of climate uncertainty. So you need to build around multiple objectives. The second thing I would say is make sure you tailor your approach to local needs. So we're investing in sustainable agriculture now in 3 different regions and have grown this over time. So we started out in Latin America, a big focus on certified agriculture, a lot of also difficult classical commodities around cattle, right? But these are the largest driver of deforestation in Latin America is cattle, and yet it's so easy to avoid it and focus on simpler topics. But you have to really be prepared to do this. And when we went into sub-Saharan Africa, this looked very, very different, what we're financing. And when we finance agriculture in this region, crops and pulses and grains and vegetables, it looks really different again. And then the last thing I want to say here is really vital in the agricultural space in particular is to aggregate. And so you have agriculture and impact is happening at the very, very fringes of value chains. It's disaggregated, it's spread out across millions and millions of producers. So you as a fund or as an investment vehicle or as a development bank, you have to find ways to reach that. So what we do is we work via two different types of aggregation. The first is very much around producers and primary processors and traders, right? They have a vested interest. They're aligned. They want to be resilient. They want to have quality. They want reliable producers, and they want to meet regulation. But also banks, and banks are also equally aligned. Why would a bank care about sustainable agriculture? They want better clients. They want better portfolio. They want price premiums for their clients. They want offtake. They want good land stewards. They want less exposure to shocks. They want better performance in portfolios. And when we talk to banks, this really resonates with them. And that's the biggest way that we deliver. Of the roughly $4.5 billion of agricultural finance we've delivered to date, the vast majority has flowed through partner financial institutions. So I would leave that here as my last point on what's useful in the blended space. Thank you.
Fantastic. Thank you so much. And already a lot to think about. And we're going to keep going and bring in Jason next, if that's okay. Over to you.
Thank you. It's a real pleasure and an honor. Thank you for the invitation. I represent the Global Environment Facility, the GEF. So why does the GEF care about blended finance? Why do we think blended finance is a good idea? I'd like to illustrate why using the famous UN adaptation gap report, which is just coming out, it's in the process of coming out now, for 2024, it's appropriately called Come Hell or High Water. Come Hell or High Water. And that articulates the scale of the adaptation gap currently being up to $359 billion a year. $359 billion a year. How the heck is that going to be met? How can we meet that? Public funds are a finite resource. We have the GEF, we have the Green Climate Fund, the Adaptation Fund. This is great. We're currently, collectively, all the multilateral climate funds contributing less than 4% of the current funds going to just the focus on adaptation. But we still have a $359 billion gap. So very clearly, it's a little obvious that we need to use these public funds, including from bilateral sources and development finance institutions, really strategically to catalyze what's not a finite resource, which is private capital and private investment. The Global Environment Facility is one of the multilateral climate funds that services multiple conventions, climate, biodiversity, desertification, and others. We have a big focus on resilience and adaptation. Within resilience and adaptation, by far agriculture is by far the largest thematic focus, as you can imagine, for good reasons. And we have a whole series of investments. I'd like to share just very briefly a few examples to show how the space is moving and how the space is developing. Agri3 with Conservation International. This is a $1 billion fund together with FMO, Dutch development finance institutions, to work with microfinance institutions providing lines of credit at accessible, just, equitable terms to smallholder farmers to transition to climate resilient practices, because it's not just training and technical assistance that farmers need. They need infusion of capital at reasonable terms so that they can get the inputs they need to transition. This is combined. So this is, we're providing partial risk guarantee to together with FMO and financial investors, and combined with the technical assistance facilities to train smallholder farmers in climate resilient practices, and importantly to train financial intermediaries, microfinance institutions in the evaluating and the monitoring of risk and impact in the resilience and agri-space. That's one. Agri-Ventures 2 with IDB. This is an equity investment fund investing in the scaling of ag tech early stage SMEs for both nature, biodiversity impacts and resilience impacts. The GEF provides a $5.5 million equity investment that's junior capital in a capital stack of totaling $55 million. A third is a Catalyst Fund. We provide project preparation finance to move this larger scale fund to climate resilience and adaptation in the agriculture space, fintech sector type enterprises in the agriculture space. Working with Gowa Capital on developing a fund together in partnership with the Green Climate Fund, our sister multilateral fund, and CAF, the Latin American Development Bank, on creating lines of credit, again, for microfinance institutions focused on resilience and adaptation solutions. I would argue we need a combination of new models and deepening existing models. Huge urgency and huge opportunity. What does give me motivation is we've turned the corner in the discourse of public-private investments on adaptation and resilience, including from the agriculture space, to a narrative of this is a public finance discussion, this resilience, agriculture, food systems, and it's an issue of morality. That's what we were saying just a few years ago. That's switched, that's shifted. We've turned the page to an issue of materiality. There isn't a private company out there, especially in the agribusiness space, who isn't deeply and profoundly concerned about the risk of climate change for their investments. And now we're shifting the narrative, shifting to a discussion of massive opportunity. It's a massive opportunity for private investors, and blended finance provides a massive opportunity to address this scale of the adaptation gap and the resilience gap for agri-systems. I'll stop there.
Fantastic. Thanks so much. Over to our third, but definitely not least panelist. Christy, have you got a microphone and are you ready to go?
Thank you very much, Ruth, and great to be here. I guess quick introduction to the Australian Sustainable Finance Institute. I expect most of you haven't heard of us. We're an Australian-based organisation that was established 3 years ago by some of Australia's largest superannuation or pension funds, big banks, insurers and financial services companies, essentially to drive and shape the sustainable finance agenda in Australia and in our region as well. So we work very closely with government, with the Australian government. We work back with financial institutions to ultimately get more capital flowing to climate, environmental and social outcomes. Before that, I was working in the Australian government and I led our blended finance programming, the establishment of the portfolio of blended finance initiatives with a focus in Southeast Asia to mobilise private capital for climate, gender and broader development outcomes. So I guess I'll draw on both of those experiences in a few opening remarks. When I was in the Australian government, as I said, had that strong focus on Southeast Asia, and we don't in Australia have a development finance institution. So there's pros and cons of that. One of the pros is that you're able to be a bit more flexible and creative in the way that you deploy grant finance in a much more catalytic way than development finance institutions are often able to. But one of the market gaps that we identified through that early scoping work back sort of 7 or 8 years ago was the time and cost it takes to develop blended finance models. So whether that's a fund, another kind of bond structure, whatever that is. And Lachlan mentioned a little bit about this. The need to spend time understanding investor expectations and what investors will invest in, and also understanding the context and what sort of the market gap or what the right financing instrument and approach is for the particular impact that you're trying to create. So a lot of what we did quite early was providing grant funding through a partner called Convergence to support the development of blended finance models. And lots of those, for very good reason, had a focus on sustainable agriculture. So one of those, just to provide a quick example, was the Asia Climate Smart Landscapes Fund that ADM Capital has developed with a focus in Indonesia. That's a $200 million fund providing long-term, small ticket size loans, so 15 to 20 million loans to small and medium enterprises in sustainable agriculture, land regeneration, and working a lot with wholesalers and aggregators at the local level, again, to build on Lachlan's point, who are the intermediaries and aggregators that can get you to that large amount of farmers. So that was sort of one example of some of the way that we catalytically provided grants to develop these blended finance structures that then allows other public and private capital to come in to scale the model over time. At ASFI, we now work with commercial capital providers, so some of Australia's largest banks, and we do quite a bit of work on nature and in the agriculture sector in particular. And that's for a couple of reasons. One, agriculture is both a significant risk if you're looking at nature risk from a commercial financial institution perspective. It was great to hear your comments, Jason, talking about it's now a materiality conversation, and it absolutely is from sort of a climate resilience, but also a sort of disclosures of emissions across financial institution portfolios. The agriculture sector is front and centre of how financial institutions are thinking about nature in particular. And then also with asset managers as well, there's a lot of interest and appetite to invest in climate resilient agriculture and sort of climate mitigation in the agriculture sector, but at least in the Australian context, there's not a lot of understanding about what that actually looks like at kind of farm level or at asset level. So the work that we've been doing is with a research institution who has collected a whole lot of data across different farming systems in Australia to identify the 3 or 4 indicators that are most material to farm productivity, resilience, and ultimately commercial profitability. Once we understand those, and the work we're doing is translating those back into financial institutions, they're then able to structure, these are commercial products, not blended finance products, but commercial products to support farmers to make that transition at the farm level. So what our financial institutions are most interested in is what are those practices that they should be encouraging their agri-client base to be adopting? Where are those things that are creating quite immediate term kind of bottom line benefits for the farmers? And how do they reduce what they're requiring and focusing their farming clients on? So it's not the 80 things that you could be collecting data on, but the 4 things that actually really matter to all of those things, to natural capital, to resilience, and to profitability of the farming enterprise. And then for the banks and financial institutions, it's what financial products can they structure off the back of that information to give the capital as well as kind of the knowledge and understanding to their farming clients. In Australia, there is blended finance still domestically for agriculture, and our Clean Energy Finance Corporation, which is our domestic green bank, does invest in sustainable agriculture, often because there's a lag between when a practice will kind of bring those commercial benefits and returns, and to bring kind of large superannuation or the pension sector into larger scale sort of sustainable agriculture in the domestic level. So just to finish up, I guess, a few key things, and this is really pleasing to hear this very much builds on and echoes the points that both Lachlan and Jason made in terms of things that are really important for the success of sustainable finance, sort of sustainable agricultural blended finance models. And the first is around alignment of investors, and we heard a little bit about this before, but investors in a fund structure are with you for 10 plus years. There needs to be strong alignment around the strategy of the fund, really clear on the risk, return and impact that different investors are seeking. That's not all going to be the same, but everyone needs to kind of understand and align around those things. And knowing how, because it is a long-term partnership, knowing how those group of investors and partners will work together over the term of that investment period is really important. The second one I would say is the importance of aggregators or intermediaries, and that can take many different forms. That might be local financial institutions, it may be wholesalers, it may be off-takers. It can, in the agriculture sector, take a range of different forms, but they really need to bridge the gap between the investors and the on-ground kind of farmers. That is not an insignificant gap, and so there may be multiple kind of intermediaries that need to come in around to make these types of deals work and to make these scale over different kind of contexts and timeframes as well. And then the third one is around the solid understanding of the on-ground practices that the finance will unlock and where, I guess, the need and gap and therefore how you structure concessional finance around that and how you're structuring the financial product at the sort of ground farm level to overcome those barriers in addition to kind of capability and capacity. So I think all of those things really critical to making blended finance not just work but to scale and achieve the impact that we need it to.
Thank you very much indeed. I'm making copious notes to take away with me, not least from all those excellent presentations. I'm now going to turn to some audience interventions, and I understand that there's a small group of people who've identified themselves as wanting to come in. So I'm going to bring them in one at a time, but I'm not going to do it without putting my glasses on because I can't see a thing on the piece of paper. So bear with me a second while I do that. And also, please do accept my apologies in advance if I don't entirely get your name right. I think the first intervention is from Evgeny Risovich, who's the Director of Investor Relations and Sustainability at MAIB, who I think is coming in virtually online, if that's okay. So, yeah, over to the wonderful technicians to sort that out for me. Oops.
He is not coming.
Oh, okay. Well, that's okay because we can move on. And I think we have Emmeline Fellus in person in the room. Is that correct? Fantastic. Hello, Emmeline. And you are the Director of Food Reform and Sustainability and Health at WBCSD. Excellent. Over to you. Thank you.
Thank you so much. Thank you. I've also taken a lot of notes, just like you did. By the way, congratulations on your nomination.
Thank you.
Thank you to the organizers for this panel. Yes, so I represent a lot of companies that are working in the World Business Council for Sustainable Development. We have about 250 companies. And indeed, the biggest, I would say, hurdle and lever in order to facilitate the transition to more nutritious and sustainable food systems is how are we going to mobilize finance and where does finance come from. So first of all, I want to thank you so much for making blended finance a word that now I feel very comfortable using and demystifying a little bit. And I would say that indeed, we know that there is a lot of potential amongst different stakeholders, but the question is how are we going to make this blended finance work together? How are we going to de-risk? How are we going to share the cost and the risk across the value chain and with other stakeholders as well? I picked up on, Jason, I was intrigued by the number you gave. You said $359 billion per year we're going to need. Where are we going to get it? I just want to remind everyone that UNEP, FAO, and UNDP published a report in 2021 that actually said that 540 billion, so beyond what we need, are going to agricultural subsidies every year, and that 87% of that is detrimental to health and to nature. So just want to say that there is money somewhere, but I agree we can't just count on public money. So really it's how are we going to leverage all of that. So I just want to say that there is many examples of how companies, like for instance, one of our member companies, Nutrien, has worked with USDA. So that's a very good example of bringing in public and private side finance, where they wanted to help farmers use less inputs. But this was seen as, of course, giving a risk. And so there was no insurance that wanted to cover that. So actually, Nutrien came in and helped to say we will compensate the farmers in case of yield loss. So there is a lot of examples out there, but we indeed need to scale it up. So I'm really very, very grateful for the examples they've given. And also want to say that, we're really all in there together. And it's nice to see that finally there is some pickup. And hope that we're going to really upscale that. Thank you.
Fantastic. Thanks very much. And I think we'll take a couple more, and then ideally we'll have some time to come back and maybe get a couple of reflections from the panelists, if that's okay. So I think we should have Jeff Whaling in the audience, who's the founder and chairman of Replant America and Replant Africa. Jeff, over to you. Thanks.
Great. Thank you. Do you mind if I stand?
Please do.
Thank you very much for this opportunity. My name's Jeff Whaling. I have the great pleasure of bringing back a commodity that is probably one of the most challenging on the planet, and that is industrial hemp. But it is not that difficult to believe that this commodity that once was a sustainable commodity around the globe is now the most sustainable, climate-smart commodity on the planet. We in the United States have passed legislation. I chaired the National Hemp Association in 2018, and that legislation has now led to 62 countries around the world, including Australia, passing legislation. I have a little bit of background in fundraising. I have done 34 rounds of raising funds to the tune of about $8 billion, and I decided to focus on industrial hemp. We knew that the markets were going to be challenging. So we decided to use something in the United States called a SPAC, a special purpose acquisition company. I was the very first group that ever raised money on Zoom. And in 7 hours on Zoom, we raised $242 million. We were required to spend about 80% of that money on a principal initiative, either buying a company or blending companies. We realized that there are no hemp companies on the planet that we could do that with, and I ended up buying a LiDAR technology company. The challenge is, obviously, industrial hemp has been prohibited around the world, and where do we come to get money? Most bankers are a little bit concerned about industrial hemp. They're not sure that they want to undertake the risk. So we went to Congress, and we talked to them about creating a fund specifically to create or rebuild, stand up the hemp industry. We have a perfect example of a blended finance opportunity created by USDA. It is the first fund that's been created by them. It is a leverage fund, so for every dollar that we will raise, they will match it by $1 up to $250 million. And that will allow us to go out into the private sector to de-risk the investment of the private sector. Industrial hemp has a global opportunity of $15 trillion. It is for food and fiber and bioplastics and energy. And how do you stand those industries up? It's going to take hundreds of millions, if not billions of dollars. But this is one example of what we have done in the United States. And I'm proud to say that our experience has now got Africa and South America also coming to us and asking us through their import-export banks to create similar funds with them. So this whole idea of blended financing is now starting to capture the attention of the world, and this is how I believe we're really going to be able to address regenerative agriculture. So I thank you all.
Thanks very much, Jeff. Excellent. I think we have someone on the line. They're both there. Fantastic. That's great. Well, welcome. I know it's difficult to join from different places around the world. Do we have Evgeny Risovich? Is that correct? And can I pass over to Evgeny?
Yes. Hi.
Hi.
Thanks for pronouncing my name correctly.
Oh, thank you.
Excellent. Love it. Yes. So. Yes, thank you for inviting me to take part in this discussion. It's a big honor. First of all, just very briefly, a small plug about MAIB, the bank where I work. MAIB is the largest bank in Moldova. We have 1.2 million clients in the country of 2.5 million. We are the leaders in all segments with about 35 to 40% of the market share. Actually, we used to be called Moldova Agro-Industrial Bank, so this is where our legacy is. We have a very long history with the sector. And even now, 40% of our SME borrowers are from agriculture. Our leading shareholders are EBRD, Horizon Capital, and Invalda, a Baltic asset management firm. We work extensively with international financial institutions, including GGF, EFSE, represented by Lachlan on your panel. We have a green portfolio of about 1 billion lei, local currency, which is roughly 13% of all our investment loans. All our green loans, I have to mention, are driven by commercial opportunity. 95% is renewable energy, mostly solar panels. So a few words about our experience with climate smart agriculture, and maybe then I'll transition into what has actually been successful with us from commercial point of view. A year and a half we worked with another international financial institution, IFC, on a so-called climate smart agriculture lending product. It covers many different tools, including no-till plowing and smart irrigation and things like that. They were aiming to copy the model that they've implemented in Ukraine, in Moldova. But what we found is that Moldovan agricultural sector is very different from Ukrainian. In Ukraine, they have very large commercial agricultural enterprises, And in Moldova, our farmers are very small and fragmented. And they simply don't have the ability to work on long-term projects, make big investments, big challenges collateral. And as a result, this product was not deemed commercially viable. Right, but this is not the end of the line, because next year we made it our goal, one of our ESG goals. We have quite a few of them, to bring it back and establish this climate smart agriculture product. And this time we plan to use a different model, a model that we had with another financial institution, with EBRD. You probably heard about their JEF program. It's a program where loans are supplemented with grants. They have a number of donors, so the borrowers can use those loans to buy certain energy-efficient equipment, or sometimes it can be even climate-smart agriculture equipment. They receive grants, and this program, administered by us, has been immensely successful. So this time around, with the climate smart agriculture product, we are hoping to find a partner for also to provide grants, but we will also use our own incentive fund that's sourced from our own profits to drive this product, which we hope will be successful. So that's my take on how we can succeed in this arena.
Fantastic, and really good to hear this range of very practical examples. Thank you so much, Evgeny. That's great. I'm going to continue going along my list, and I think we have Barbara Visser, is that correct? Who's the Chief Operating Officer for IDH Investment Management, IDH FarmFit Fund. Barbara, are you there?
Yes, I am. Thank you, and thank you for inviting me, and apologies that I couldn't be there.
Thank you for coming.
Yeah, well, I'm happy that I could contribute online. So yes, maybe a little bit about the IDH FarmFit Fund. The IDH FarmFit Fund is a €100 million blended impact fund. We have a tenure of 15 years, and we are dedicated to smallholder value chains. We aim to reach 3 million farmers and increase their income with 50%. Ultimately, we want to demonstrate that smallholder finance can be commercially viable. We have 3 layers of where we mobilize or catalyze capital into this. So first of all, it's on fund level. So we're a €100 million fund. The first 50 million came through a redeemable grant from the Dutch Ministry of Foreign Affairs. And this acts as a first loss risk instrument, which mobilized then 50 million from corporate lenders, including Unilever, Rabobank, Mondelez, JDE Peets, and FMO, the Development Finance Institution in the Netherlands. And these loans are senior to the redeemable grant of the Dutch Ministry of Foreign Affairs. So that's on fund level. Then on the second mobilizing component that we have is that we take up to 50% high risk positions in smallholder related investments. And by doing so, we also are able to mobilize more senior investors into a transaction. Then we have a third layer as a catalyzing component, which is on portfolio company level. And as an example, I can mention an investment that we did in COA, which is a cocoa juice processing facility in Ghana. And we were one of the first investors, together with the Landscape Resilience Fund, for them to set up their processing facility in Ghana. And that really allowed them to increase their follow-on equity round, because other investors indicated that they would have not come on board if the FarmFit Fund and the Landscape Resilience Fund wouldn't have come in first as taking the highest risk. Where we really see a need for blended finance is in supporting smallholders in making a transition to regenerative agriculture. This is absolutely crucial because the blended finance structure can really help with covering the delayed financial returns and also the patient capital that's needed to allow for this transition. And to really use a mix of financial returns, was mentioned before, to incentivize more senior and commercial investors. So it's really to support that delayed gap of financial returns and also impact returns. And that's maybe my second point. What is absolutely crucial is that there's alignment on technical assistance impact targets that are expected and sometimes imposed, and the very delayed impact targets that you have when you're transitioning to more regenerative practices. So having better alignment on that is absolutely needed, and call upon the governments who provide donor money for TA to really allow investment funds like us to have that delayed impact targets as well on technical assistance. I think another thing what we have seen is very important is the role that governments can play in pushing regulators to maybe allow for certain or push for certain investment criteria. So one example is in India, where the Reserve Bank of India has a target on how much has to be invested in agriculture, and even a target on how much has to be invested in smallholder-related portfolios, which really has opened up in the last years in opportunities to invest in regenerative smallholder agriculture in India. So there are so many possibilities that governments can do in that larger blended finance system that we think is absolutely important. Yeah.
Fantastic. That was exactly what we needed, is to get some prompts and challenges to governments about the things that they could do to drive the agenda further forward. So thanks very much for that, Barbara. I think our last sort of planned intervention, and I may struggle with the name slightly more than I have done with others, forgive me, is Bernard Stormier. Would that be correct? Hello, Bernard. It's very nice to see you. Vice President of Sustainability Governance at Yara. Over to you.
Thanks. It's a pleasure to be here. First, a couple of examples of how we are working with blended finance. So our business in Sub-Saharan Africa is benefiting from a first loss scheme from the African Fertilizer and Agribusiness Partnership backed by USAID. So this enables our distributors to take on board larger risks when making business with us and selling to the smallholder farmers.
I think you need to pick.
Yeah. And another example is more on the private side, how we have partnered together with an insurance company and with a local bank in Tanzania, leveraging Africa Connect, which is a cell phone-based network of agribusinesses and smallholder farmers, to offer both financing and, importantly, insurance to the smallholder and commercial scale farmers of Tanzania. So that has now made more than 83,000 farmers start using crop insurance schemes, meaning that then they can more confidently invest into their farms. But I also have a question to the panel, and maybe primarily to you, Jason. When I am discussing blended finance with our commercial teams in Sub-Saharan Africa, they point at a lack of medium-term commitment for public-private partnerships, and also a clear willingness to involve the commercial and private sector perspective when developing projects. So how can we make sure that all the work that's being done on blended finance and on supporting the smallholder farmers can clearly have not just a short-term but a medium-plus term commercial perspective on bringing the farmers into a viable commercial operation?
Thanks so much. So a really interesting set of interventions. struggling slightly with the mic. Can you hear me okay? Yeah, perfect. Great. And I'm very glad that we've got time to go back to the panel, because I think we're beginning to sort of distill some of the questions to put to government. And in a way, this is a consultation process, I think, for governments to try to understand the things that they would need to do next in order to be able to help you to scale up in the way that you would like to do so. So I'm going to be quite crisp. I think it follows on from a bit of what Brennan was saying, but I'm going to just go to the panel and I'm going to ask them if they could have one policy wish from a set of governments who are their supporters and backers. What would you like a group of governments to be doing as a single policy change that you think would be the most likely to move from a situation in which, let's say, you are operating in a relatively small part of the market to a situation in which the norm is investment in sustainable agriculture? What would need to happen to move us into that position? So I'm going to start at the other end with Christian, come back this way if that's possible. A minute each, if that's okay. Go for it.
Great, thank you. And this is an excellent question and something we think about a lot, because ultimately kind of our mission and objective is to shift the whole financial system so it's more sustainable, resilient and inclusive. I think what we've heard from the interventions is that it's about insurance as well as just banks and investments, so thinking about that whole of financial system. And blended finance is about getting capital right now to these things. But my one policy wish would be to think about this more broadly than just the blended finance transaction, and think about as aligning financial sector policy and regulation with sustainability objectives. So it's both of those things.
Fantastic, very clear, thank you. Go for it, Jason.
Thank you. We need stronger, my one policy wish, we need stronger investment frameworks. Sometimes they're called taxonomies, for investing in agricultural sustainability and in resilience. We need to recognize and reward investors that are investing in resilience and sustainability. We're starting to develop green taxonomies at global scales. We need them to be nationally owned, and especially owned by governments and countries in the global south. If we can do that, we start to get to the massive perverse incentive issue, which is arguably the single biggest opportunity for nature and for climate action, is removing crazy perverse incentives, and we can get to more medium and longer term investment strategies. So strong investment frameworks and taxonomies owned by the global south that then are linked to policy to actually incentivize investment in those taxonomies. Thanks.
Brilliant. Over to you, Achim.
Yeah, thank you. And I very much agree with the points made by so I'll try to say something additional, and also try and build a little bit on what Bernard hinted at, which is I think there would be real value in having more planning certainty around growing and building blended finance efforts. So if there is earmarking of a certain amount, and it can be thematically to agriculture, by government, and this is clearly communicated and it's transparent and you know where to go and you know how to engage, I think then you're just so much more powerful than everybody sort of running around doing their own thing, uncoordinated. So I think more coordination, more earmarking, more transparency in terms of what needs to go into blending, because we know it needs to go there. There's no doubt we have to grow it, and it has to come from somewhere. So making that easier to engage with. Yep.
Great. I've given myself just enough time to be able to take one question from the audience, which I'm really pleased about. Would anybody like to make a 1-minute intervention? Excellent. The lady at the back who has her hand up very, very quickly. If we can pass the mic over to her, that would be super. Go for it.
Hi there. It's on. Hi there, Jenny Brunton. I'm with the farmers constituency here at COP and from a farm in Scotland. Obviously, this is reflected just largely on blended finance, but really from an agriculture perspective, I really just wanted to highlight that, definitions of sustainable agriculture across the world varies. How we define this, how we identify farmers' needs is very complex. And I think just something I really want to highlight is to include farmers in this decision making, and it might just be a bit more inclusive if we have more farmers' voices represented, where we're not just being told what we should be doing, but actually we're telling you what we need in order to deliver that. Thank you.
Thank you very much. I couldn't agree with you more. That does deserve a round of applause, absolutely. A point I would have liked to make myself, so very grateful for that. We've got 2 or 3 minutes left, and I'm just going to try and do a very sort of crude summary of some of the things that I think that we've heard and we might take away with us. I think from the panelists and others, we clearly hear that in the context of wanting to attract private finance and private investment, there is no point in doing that unless you're actually able to create the institutions and products that speak to what the private sector needs and how the private sector works, and that is one form of alignment that you're clearly advising needs to be an important part of the story. I also very clearly heard that you are directly addressing the challenge of aggregation, which I know is a kind of massive difficulty, and I think really speaks to our colleague and friend who's just spoken for farmers as well. That the difficulty we all know exists here is that investors are wanting to move money at scale, but you're often dealing in a context where you have many different multiple actors in a context where they deserve and have the right to be able to drive some of the demand themselves and participate in the process of decision making and determining what sustainable might look like. And I heard various different kind of views from the panel about what those aggregation kind of mechanisms might look like. I think that's something that's really kind of worth digging into in the sense of, you know, kind of what works in different areas. I'm assuming you can't just have a one size fits all like aggregator context, and that part of that's about, you know, kind of national political and cultural circumstances and how that works. So being able to sort of understand that a bit more, I think would be really helpful, but it's also really encouraging. And then I'm going to poke at, for the last kind of sort of couple of minutes at the really kind of tricky problem of taxonomies, standards, you know, what this actually looks like on the ground. And I thought there's been a fairly sophisticated conversation in terms of recognizing that somewhere up in the stratosphere, people are attempting to try to create sustainabilities, taxonomies around sustainable agriculture. And perhaps those conversations do need to happen at the level of global institutions. But we all kind of know as practical people that is so conceptual that it either becomes completely inapplicable at the local level because it doesn't take into account actually kind of, you know, national, regional, local circumstances, or it is so high level and vague that it would accommodate virtually everything. And at that point, the definitions become kind of meaningless. So the other thing I'm going to sort of take away from the conversation is how do you move up and down the register in the development of taxonomies in a way that takes account of what a group of farmers might be working on in a particular landscape, and where they have a very clear perception of how their soils and their climate works. Move that up into, I think, you know, you were very clearly talking, Jason, about the need to have something that operates at a kind of national taxonomic level. How do you then also make that meet with the kinds of new standards that you might introduce into a different sort of subsidy or repurposing regime, or into technical assistance, for example? And then how can that be a meaningful conversation at a global level? And that feels like a really substantial challenge to take away for governments to think about. And the final point, I think, is that every single one of you said that what you would like to see is that there is government leadership in terms of the development of those taxonomies, so that there is a framework that means that you're not pushing from where you're standing against the system, but actually you're working within a framework and a system that is going to kind of enable you to move forward. So I hope that was a reasonable summary of some of the points around the table. I've given you 30 seconds of your lives back. Thanks ever so much. That was a really brilliant conversation. And thanks very much to our excellent panelists. Thank you.